Let's be honest, trying to understand the Indian tax system can feel like you're lost in a maze, right? You've got income tax, GST, and just a ton of rules and weird little quirks. So today, we're going to try and draw a map of this labyrinth. We'll start with a real-world problem that honestly just doesn't seem to make any sense, and we'll follow that thread all the way back to the ultimate rulebook that runs the whole show. Let's dive in.
So here's our game plan. First up, we're going to look at a super strange income situation that seems to break all the rules of logic. Then we'll get our definitions straight. The key terms that make this whole system work. After that, we'll walk the tightrope between what's legal and what's illegal when it comes to taxes. We'll even ask a wild question. Can the government tax you for something you did years ago? And finally, we'll see how the Constitution of India is really the key that unlocks this entire puzzle.
All right, let's kick things off, not with some dry legal theory, but with a real-world head-scratcher that was actually making the rounds online. It's a situation where getting a raise can actually make you poor. I know, right? How is that even possible? Well, let's actually look at the numbers.
This one comment from a user on Reddit perfectly captures this bizarre little quirk in our tax system. I mean, at first glance, it feels impossible. You earn more money, you should take home more money. That's just math, right? Well, apparently not always. And this comment, pointing the finger at something called a surcharge, is what kicks off our whole investigation today. And boom, this table lays it all out. Just look at these numbers. If your taxable income is 50 lakh rupees, your take-home pay is about 36.35 lakhs. But if you get a raise of just 1 lakh, bringing you to 51 lakhs, your take-home pay actually drops to 36.31 lakhs. You've earned more, but you're 4,000 rupees poorer. The culprit here is a surcharge that kicks in right at that 50 lakh mark. And to get why this happens, we first need to get our vocabulary straight. Okay, to solve that puzzle, we need the right tools. And in the world of taxation, the words you use matter a lot. So what exactly is a tax? And how in the world is it different from a fee? And what are these surcharges and cesses that are causing all this confusion?
So let's start with the big one. Legally speaking, a tax is a compulsory charge that the government puts on people or property to, raise money for public purposes. But simply, it's not a payment for some specific service you get. It's your contribution to keep the whole country running. And this is where the difference between a tax and a fee is so important. A tax is for general stuff. Think national defense, building roads. A fee, on the other hand, is what you pay for a specific service you get. Like when you pay a fee for a passport. You're paying for that one thing. And this isn't just about words. The Constitution itself draws a really hard line between the two, giving the government totally separate powers to charge each one. And here is our mystery guest, the surcharge. The easiest way to think about it is as a tax on a tax. So when your income crosses a certain high-level mark, the government doesn't just tax your income. It slaps an extra charge on top of the tax you already have to pay. And that's exactly what caused that weird drop in take-home pay we saw. Now, the government does have a fix called marginal relief that's supposed to soften the blow, but as we saw, these strange things can still happen right at that tipping point. Then you have its cousin, the Cess. It's also a tax on a tax, but there's one massive difference. The money collected from a Cess has to be used for a specific purpose that's declared up front. So if you see a health and education Cess on your bill, that money is legally ring-fenced. It can only be spent on health and education, not on just any old government expense. Okay, so we've got taxes, fees, surcharges, cesses, all of them taking a piece of the pie. The totally natural response to all this is to think, okay, how can I pay as little as legally possible? But that's where we hit a really critical dividing line, the line between legally minimizing your tax bill and illegally hiding from it. Let's be super clear on this one because it's important. Tax avoidance is legal. It means you're using the existing rules of the game, and yes, sometimes loopholes in those rules, to arrange your finances so you pay the minimum tax you're required to. Tax evasion, on the other hand, is flat out illegal. This is all about deception, hiding income, making up expenses, or just not filing your taxes at all. One is playing by the rules, the other is cheating. So why do people risk it? Why do they evade taxes? Well, research usually points to a few main reasons. For one, really high tax rates can make people feel like the system is unfair. The crazy complexity of the tax laws can also make it feel so overwhelming that just not dealing with it seems easier. Sometimes a lack of clear rules creates gray areas that people exploit. And finally, if it seems like nobody's really checking and the penalties aren't that bad, some people will just decide it's a risk worth taking.
Okay, get ready for a mind bender. Imagine you closed a business deal 5 years ago. At that time, under the law, it was completely tax-free. But what if the government passes a new law today that makes that exact kind of transaction taxable? Can they reach back in time and tax you for it?
Well, they can. It's called retrospective taxation, and it is one of the most powerful and definitely most controversial tools a government has in its toolbox. It basically lets them turn back the clock and apply a new tax law to things that have already happened. And as you can imagine, this creates a massive amount of uncertainty for anyone doing business.
So what's the big deal? Well, at its very core, it kind of messes with a fundamental principle of law, fairness. How can you confidently make a deal today if you're worried the government might just change the rules 5 years from now and send you a bill? It just completely undermines the predictability you need from a stable legal system. And trust me, this isn't just some legal theory in India. This has a real history. Way back in 1962, the Supreme Court actually ruled that there was nothing in the Constitution that explicitly banned these kinds of backwards-looking laws. That basically opened the door. And in 2012, the government walked right through it, passing a major retrospective amendment that led to some really famous high-profile fights with big international companies. You know, all these issues, the weird surcharges, tax evasion, these retroactive laws, they all lead us back to one single foundational document, the Constitution of India. It's the document that lays down the fundamental rules of the game. It says who can tax what, and crucially, what the limits are. There's this famous idea, captured perfectly by the American Chief Justice John Marshall, that's been quoted in Indian courts too. It's that the power to tax isn't just some extra feature. It's absolutely essential for a government to even exist, and our Constitution is what grants that power. But here's the really clever part. It doesn't just grant this power to one entity. It divides it. This is the federal heart of Indian taxation. Article 246 creates 3 lists. Think of them like buckets. The Union list gives the central parliament in Delhi exclusive power over big things like income tax. The state list gives the state governments power over things like agricultural income tax. And the concurrent list covers areas where they can both make laws. This structure is everything. But, and this is a really big but, that power is not a blank check. A tax law is still a law, which means it cannot violate the fundamental rights that the Constitution guarantees to every citizen. For instance, a tax can't be designed to unfairly discriminate against one group of people. Having said that, the courts also recognize that to make a tax system work, the government needs some flexibility, what they call wide latitude, to classify different things and people for different tax rates. The Constitution also does something else that's super important. It makes sure India stays as one single, unified market. The Commerce Clause, specifically Article 301, says that trade has to flow freely between states. This means one state can't just create a tax to protect its own local businesses by making it super expensive for goods to come in from a neighboring state. The goal is to keep the whole country's economy interconnected. And that brings us full circle, right back to where we started. That weird surcharge rule, the one where earning more could mean taking less home, it's not just some random glitch in the tax code. It's a tiny, visible piece of this huge, ongoing balancing act that's baked right into our Constitution. The balance between the government's absolute need for money and the fundamental rights and freedoms that are guaranteed to every single citizen. So when you boil it all down, that's what we're really talking about. Every single tax, every rule, every little surcharge, it's all part of this incredibly delicate balance between the power of the state and the rights of the citizen. And the question that leaves for all of us to think about is, do we think that balance is currently right?